Good morning, good afternoon, good evening, depending where you are on the planet. And welcome to the Bull versus Bear webinar. Steve Miley on the call for trade day on Thursday, 11th of August. Welcome, everyone. Welcome, SB Jalal. Welcome, Clinton. So to answer your question, I assume the dashboard isn't updating at this time. If you're talking about your evaluation challenge dashboard, we have had an issue with some data issues with it not updating for some users. And that is a fix is being sorted for that, just so you know. And there's been no lost data, so don't worry about that. And that fix should push out hopefully in the next 24, 48 hours, certainly by the beginning of next week. But don't worry, none of your data is missing, whether you've had losing, winning days, whatever that is. It's all good. But I know it's frustrating. It's beyond our control. It has been investigated. The problem has been found. There is a fix in the pipeline that's being pushed through. So I hope that answers your question. Okay, if that's what it was regarding. I assume that's what it was regarding, right? The other thing I just want to say is I am going on vacation from tomorrow. So James will be covering the webinars going forward for the next few weeks. I won't be back with you until probably my next webinar might not be till after Labor Day, actually. This will be my last webinar. So going into tomorrow and then the next few weeks with James covering and with obviously less coverage, we may not be having webinars on a daily basis, is what I want to say. Okay. So you might need to check the activity feeds, check the chat. Okay. To see when we're going to schedule those. We've kind of undecided, but we might just go down to maybe doing 2 or 3 a week. Okay. James is going to do his utmost to do as many as possible. And whether we do them on set days or whether James will do them as and when he is able, or as and when the markets are maybe more conducive to doing a webinar. But our apologies for that. But I'm away, and there's only so much we can cover, as it were. So just bear that in mind as well going forward. Okay, but there'll be updates within the activity feed, in the chat, on the forums, etc., as to when the webinars will be. So keep an eye out for that. Let's talk a little bit about markets. Obviously, we covered. I'm bullish, right? We covered yesterday. It's all going to be about CPI. We had the CPI data. Let's just look ahead to this week. To today. Nothing really of note due out. We get the PPI. After yesterday's CPI, I do not see PPI. So PPI coming out in just under an hour. I do not see that impacting markets too much, given how much of a movement and how much far more important CPI data is. So and how much the market has moved on the back of that. Let's talk about the CPI. It was always going to be important. So 8.5%. Cut down from the June high, less than anticipated on both the month-on-months and on the year-on-years. Okay, down below forecasts. So obviously that's a risk-on event. The other thing, gas prices was the drop in the gas prices. Well, obviously gas prices dropping as oil prices have dropped, right? So and we've been watching, the oil prices drop over the last month or so. So gas prices falling and having a big impact on that. Data with the miss to the downside, which is a positive miss, obviously, for markets and for the Fed's fight on inflation. So markets leapt higher on that. When I say markets, I mean the stock indices. The really big mover, if you want to look at where the mover was the dollar. The dollar got smashed across the board, right? Particularly the Antipodeans, the Australian, New Zealand dollars did particularly well. They're what we would class as risk currencies. They're commodity currencies. This is obviously good for growth. If inflation is starting to fall in the world's biggest economy, the US, then that's a positive in the long-term outlook for growth. It's a positive if the Fed cool off a little bit on their hawkishness. However, what we did see, so just a couple of articles on that. So obviously we've got that there, and US gasoline prices below $4 for the first time since March. That's a positive as well. And then obviously what we saw here was in the Fed tool is, remember, this was down here somewhere and it's leapt up to 60%. Now it's high. After the Fed meeting, this was up at like 80. This is for a 50 basis point hike. and this was down at 20, right? They reversed around. This was up at like 60, 70 more recently on this second column, saying a 75 basis point hike as we had the Fed push back on the narrative and as we had the big, strong employment report last Friday. We saw this up here and this down here. Now we're moving back to more of a chance, over 60% chance now at the next meeting in September, 21st September, for a 50 basis point hike. So this is telling us that there's a more of a less dovish tone expected, a less hawkish, so de facto more dovish tone anticipated from the Fed. And remember, we've looked out before by end of year. Okay, so we're still up at like 350, 375 as the peak. Okay, by year end. So even though less chance of a 50 now, more chance of a 50, less chance of a 75, we're still seeing the peak here in rates as higher. Remember, previously the peak in rates was from according to this tool, which is based on the euro-dollar curve. Okay, the short-term interest rate curve. Then this was telling us the peak in rates was going to be about 325 to 350. Okay, now it's still telling us 350, 375 through February, 350, 375 through March, 350, 375. By March, May, we were looking for the rate cut to come in. And if we go out to May, we're still seeing 350, 375, okay? And we go out to June, okay, the peak is still 353. So we're saying that rate cuts being pushed out. The rate cut doesn't now come till, according to this, out till July now, okay? And that is because of where the Fed came flying out, right? We had Kashkari and also Evans, okay, says softer inflation data doesn't change the Fed path. And then Evans saying inflation has eased, but it's unacceptably high. So straight after the release, we saw that, right? Okay. And there was a good, I think it was in the 5 things, right? I don't think it's in here, but basically their views are, rate hikes. Okay, so look, okay, here it is, Evans. Evans says he expects the target rate for central banks benchmarks 2.25 to 2.5 to rise to 3.25, 3.5. So he's looking for 100 up by year end. Okay, the curve's telling us 125. Okay, 3.75 to 4% by the end of 2023 though. So he's telling us it's going to be higher at the end of 2023. So that's not telling us there's rate hikes coming. Kashkari said something similar. Remember as well, here's Kashkari in here. If we look at Kashkari on the Hawk Dove sheet, remember our Hawk Dove sheet? I'll share this. This is from ITC Markets, okay? Go and it's in the chat below the chat. Hawk Dove sheet in here tells us Kashkari and Evans are two of the most dovish within the Fed, okay? They're not voters at the moment, okay? But that doesn't really matter because, they're still saying their view. They still get to discuss their view at the Fed meetings. They're not voters at the moment. But nevertheless, they are at the dovish end and they've stayed hawkish. They came straight out after that CPI data and were reinforced a more hawkish tone. That's why this here, going back to September, isn't all the way up here somewhere, 80, okay? That's also why the peak in rates is still saying up at 125, right? Up from here, right? And that's why the curve is not pricing in any kind of chance of a rate cut till maybe out through the summer, because what they're telling us is actually they're anticipating maybe further hikes into the end of the year for next year. Okay, so even though we had that very, 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 very positive dip in inflation, so maybe a peak in inflation now, it has primarily been driven by energy prices, by gas, as in petroleum at the pump, gasoline prices being lower in here. Okay, so and then the articles on here, so there's Fed pushing back on that, and then also in here on the morning brief, Fed doesn't see enough swallows for summer. So again, in here, talking about, look, the Fed is far, far, far away from declaring this victory, Kashkari quote, okay? And then what else do we have in here? Charles Evans saying inflation unacceptably high, the same quotes, okay? And if we go and take a look at the 5 things to start your day, where is that? Oh, where's my 5 things in here? So that's like top of here. Federal Reserve responded to softening inflation data by saying it doesn't change the US central bank's path. Okay, so again, looking. So where are we? Kashkari, he wants the Fed's funds benchmark by 3.9 by the end of this year and at 4.4 by the end of 2023. Yeah, still quite hawkish for a dove. Okay, energy prices were the driving. We've already posed that. Rents, though, surging in the US. Okay, fastest pace in more than 3 decades. Rents in the US surging higher. And it says in here, look, stocks trimmed the rally on Thursday. Okay, rally slows. Well, did it really? If we go and take a look at the where we are on the stocks in here, so European stocks actually didn't, they got some follow through, but not much of a follow through this morning in here. Okay, so we did get initial follow through and a dip back lower. But you can see in here, Europe. So, and they obviously rallied yesterday anyway. So it wasn't like this came after the market, right? This came during when these markets were open, the CPI day. But they've kind of consolidated, kind of dipped lower. But if we actually look at where we are on the US in here, so good gains yesterday. Now the S&P over 2%, Nasdaq over 2%, Dow over 1.5%, and this morning they were still up, right? So I think we have dipped off the highs, but not much. Okay, last time I looked in here, and we'll come to look at the chart shortly, but we're not far really. There's the S&P, right? There's yesterday's move. We were higher, and not much off the highs, right? So still looking very strong to me. I don't know where that headline's coming from. So where have we got? We've gone from us. The other thing I want to point out is here. So this is Forex Live. It's a great site if you haven't used it before. It's got a focus on Forex, but it does cover a lot of other stuff as well. Got a lot of rumor in there, got some technical analysis, got all sorts of stuff that streams through in here. The big thing in here was the dollar move, dollar down across the board. Dollar got smashed against, like dollar yen went down. Euro dollar had been sideways for some time. Euro dollar broke to the upside. Dollar CAD, US dollar Canadian dollar broke significantly lower. Say dollar yen that previously rebounded got smashed to the downside. And if we look in here going into today, there's seen a continuation. I said about the Antipodeans, the risk currencies. So the Australian dollar, Kiwi dollar doing particularly well. The Aussie was up like 1.5% or something yesterday. It's up over nearly 0.5% in here this morning. The euro versus the dollar had a strong rally. I think about 1% yesterday, just under. It's up like over 0.3 this morning. New Zealand dollar as well doing well, up another 0.4 this morning. So we've had a really strong move by those risk currencies. So risk currencies doing well alongside riskier assets, stocks pushing significantly higher. So yeah, all of that very, very bullish at the moment. Stocks parry rally. So again, look, stocks parry rally as risk on mood after CPI calls. Well, I don't know where they're seeing that. Maybe it was the time they'd written this, but it didn't seem to cool down. It hasn't really cooled down. We're still nudging higher as we go. And then look, Fed leaders unswathed. Okay, so it's Kashkari and Evans again. We've already spoken about that. And then investors shunning equities set the stage. But yeah, so this is so retail investors are chasing gains in meme stocks options. Hedge funds are forced to unwind short sales. So yeah, hedge funds been short in here. Retail investors and funds underweight. We know that. I think there's plenty of room for this rally to run through the summer. I really do. Onto the top side. Right. That all being said, let's look at some charts. So here's the daily. Importantly, yesterday we flagged this as a potential target. That peak up there from the very end of May, up at, on this is the S&P, 4204.75. We eclipsed that high yesterday at the end of the day, closed above that high, and then higher again in here this morning. There's a real risk we go and attack this set of highs. I remember when we failed at these highs previously, okay? I remember writing about it and thought that when we were nudging up at these levels that we were going to put a better base in on this move in here as we came down, and we held these lows in here. I thought this was the base of the whole bear move going in here. We obviously went a lot lower after that. But these are going to be some really important peaks where we failed. They're all lined up around 43.07. So you got like 43, sorry, not 43, 43.04, 43.06.5, 43.08.5, 43.07. So basically between 43.03, 43.08. Their potential targets even today. Probably not today, certainly going into Friday. But I think there's a real risk we get a really strong follow through, because there would have been initial buying in here, obviously, on the data. Stocks, remember, not open at this point. Stocks then open up here, right? So hedge funds and futures traders can come in here, but the actual real stocks don't open to over here. Real stocks open, and then there's a gradual, the market actually dips and gradually. They're buying at inflated prices. When the cash market opened, we were above the peak here, right? Above the previous peak. So they're already buying and effectively a gap higher on the cash index, okay? So cash stocks kind of gapped higher in here and then carried on higher through the session, and then we're higher again today. And look, you've had this little gut check back from the high, and here the overnight high, and then it's rebounded already. I think this thing could really go again as real money comes in. Hedge funds are short, or they may not be short now. They've been maybe squeezed out of shorts. But I still think there's potential a further squeeze on hedge fund shorts, faster money shorts. There's a real money to be put to work. We know that. Remember, we looked at the beginning of the month at the Bank of America, it used to be Merrill Lynch Fund Manager Survey. Funds are massively underweight. Okay, massively underweight. Their cash levels are at multi-decade highs, right? Since I think it's certainly since the financial crisis, and in some cases they were underweight since 9/11, right? So huge underweight positions from funds, real money accounts. Yeah, we're talking about pension funds, investment funds. That money could all come back and be put to work. Particularly now, they're going to be waiting for the inflation numbers to turn, right? And so maybe, right? That gets put to work over the next few days through the summer. Normally it's a quiet summer, but I could easily see we're seeing a significant summer rally. So yeah, I can only approach this, here on the 30-minute charts from the long side. Let's go and have a look at the Nasdaq. The Nasdaq only just managed to get above because it was coming from a deeper correction. Nasdaq only just managed to get above, and the other thing it didn't get the help from, if I go across here to the bond chart in here. So bonds initially pushed higher prices, lower yields. Okay, that should have helped the Nasdaq, lower yields, but then came back down in here. So what we really want in here is us to go to lower yields. We really want us to be pushing up here, higher prices, lower yields. Lower yields, remember, help growth stocks better. It's going to help the Nasdaq, but the market unable to do that, so it's still pointing down. And because the Fed came out, right, and this was the move in here. If we could just zoom in here, actually I'll go to a 30-minute chart, it'll show us better. So the 30-minute chart, there's the CPI, right? And then the Fed come out and it comes all the way back down. So there's CPI, okay? So bullish, up in price here on the bonds. Okay, this is the 10-year note. Up in price, down in yield, lower yields, as we would expect, right? Then Fed come out and then boom, Kashkari, Evans come to speak. Okay, not so great. So this doesn't help the Nasdaq. The fact that we're back down here. Up here helps the Nasdaq. But it does look like it's holding on to, we had the CPI rally. It's come back with the Fed. It's kind of held where the CPI, after where we were before the CPI rally. There's all this consolidation area in here. You've got this kind of big consolidation area here. Got consolidation area here as support. Consolidation area here as support. It's rebounded off of that and pushing back higher. So if bonds can get going to the upside, that's going to help the Nasdaq more, right? Higher prices, lower yields, lower long-term interest rates. Positive for growth, positive for Nasdaq. Okay, so going back to the Nasdaq. Okay, we only just eclipsed Friday's high, right? And was it Friday's high? Yeah, I think. No, Monday's high. Excuse me, Monday's high, right? We just about managed. Yeah, Friday we just about got above Friday's high on Monday, and then fouled back down lower Tuesday. Strong rally Wednesday, higher in here this morning. Critical are going to be, look, these are the same highs as I was talking about, right? I think pretty much. Let's go back to the S&P. I want to double check that these peaks here. So these peaks, they're from the where are they? The end of April, beginning of May. If we go and take a look at on the Nasdaq in here, are they the same highs? Yeah, the end of April, beginning of May. These are the same highs, right? And they are for the Nasdaq queuing up at 13,578, 582, 576. 620. So basically between 13,580 and 13,620. That's an easier target for the Nasdaq to hit today. If it can hit those, then that secures a better base for the Nasdaq, a better recovery theme. And there's real risk, I think, at least to challenge these levels. Now, you might want to book profits when we get up to those levels on an initial move, but I can easily see us getting through those today. Again, if we get this real money going to work, I can easily see that happening today, guys. And you want to watch the volume numbers as well, because volume could be high today. I didn't check the volume numbers, but I'm sure volume numbers were decent yesterday. I wouldn't be surprised to see strong volume numbers today on both the cash and the futures markets as real money goes to work. Okay, so you want to be watching that as well for maybe the first 30 minutes to an hour of trading. Not only the futures volumes, okay, watching out for what they're posting. You can get live updates on the New York Stock Exchange cash numbers, okay, watching out for those as well. Okay, I think that's going to be important. If we see real money going to work, we easily push through these levels on the Nasdaq. So they're going to be the key. And if I step into an intraday chart, look, there's the surge. The market again pushes higher through the session, overnight up, challenges topside, dips, but then rebounding already. This looks just bullish. I can't see this anything other than bullish. Right, I'm going to do a quick nod to the commodity markets in here. We'll start off with oil. So oil did get a significant sell-off and then a significant rebound. We're actually pushed above my level in here, which was the peak in here from a couple of days ago, 92.65. I think that shifts it more bullish now. If we go to the 1 hour chart, remember we looked at this failed. Remember when it went up to 92.65 here, it failed. It went above this important peak here. That peak there was 91.90 and got up to 92.65. Didn't want to make the bullish statement. Remember we said there's this multi point low. 1, 2, 3, 4, 5. Now we've got 6 all gathered in this area, and then again a more secure base. I think the risk for oil is now to the top side, and that's going to be. This is being driven by growth, right? An anticipation of a stronger growth, a less hawkish Fed, inflation topping out, better growth, stronger demand for oil upside. Okay, so we've got a better base now. And here, when we originally secured the base, the market then immediately failed. But now we've gone back through there again, a tentative push through there yesterday, and then stalled below that level, but now up and through. I think there's real risk for oil up towards at least like 94.5, 95, maybe up towards these areas up to here, these peaks, 96 to 96.5. Going into the next 24 to 48 hours, certainly for this session, up towards 95, maybe above. Let's go take a look at gold. So gold in here, remember we had yesterday a lot of US dollar weakness, which should have been good for gold. And gold was initially higher and then lower, but is rebounding. The uptrend for me is very much intact. And if we step inside in here, so you get the spike higher on the data as the dollar sold off, then you get the retreat. But importantly in here, look, we just clipped below these supports in here. Okay, so we had support here for 1 sec for gold. We had these supports in here for gold, 1799.7, just below 1800, 1799.4, and then all the way down here at 1796. So basically between 1800 and 1796, we had decent support, and the market goes down there, just clips below or goes into this support area, and then strong rebound. And look at it impulsively moving now. I think this is a great buy. I think this is a great buy opportunity on the daily chart. You know, it's a natural swing back lower. You're going to get a negative pattern yesterday and already got a bullish pattern rejecting yesterday's negative. So yesterday's like a shooting star negative, and you've already got a hammer today. I think there's a good buy opportunity for gold topside. It's already breaking quite aggressively higher now, so maybe jumping on that one as well. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. I'm going to wish you all a great few weeks. I won't speak to you. I'm going to miss you guys, okay? Be careful out there. Helmets and goggles on. You know, don't overtrade. Right? Let's keep that overtrading to a minimum. Let's be careful. Let's keep our stops tight. Okay, at sensible places to put your stops. Try and run those profits if you can. You know, play devil's advocate with yourself. You know, would I, if you're long, right, and it's going up, would I sell it here? Would I go short here? If you wouldn't go short, why are you cutting your long? Okay. Keep thinking that. Okay. Yeah. Thank you for that, Clinton. I will enjoy my holiday, and I will be back with you for early September. Keep an eye out. Keep an eye on the activity feed in the chat. You know, on the heads up on the daily update. James will be posting in there when the webinar's on. I don't want you guys sitting there waiting for a webinar that's not going to happen, but he'll keep you posted. All right. Have a good one, guys. Take care. Bye.